Rates on a fixed 30-year mortgage now over 7%. That is the highest level since '06. Diana Olick has more on the impact for homebuyers today. Morning, Diana.
Good morning, Carl. No question, higher rates are hitting home buyers hard. You can see it in the demand for mortgages and in the types of mortgages potential buyers are now looking at. First, let's get to the rate. The average on the 30-year fix is now solidly over 7%, according to Mortgage News Daily, and could move even higher today as bond yields rise due to that higher-than-expected PPI number. Rates started this year at 3%, so no surprise. Mortgage applications from home buyers dropped 2% last week, and volume was down 39% from a year ago. That, according to the Mortgage Bankers Association. The MBA also reported that it is now harder to qualify for a mortgage. Credit availability fell in September for the 7th straight month, down 5.4% from August. It's now at the lowest level since 2013, when the housing market was still recovering from the financial crisis. Now, while lenders are desperate for business, for sure, given the drop in demand, they're also concerned that a weaker economy could cause an increase in mortgage delinquencies. So they have a smaller appetite for lower credit score borrowers and riskier loans, which unfortunately now coincides with stronger demand for those riskier loans because they offer lower interest rates. The share of adjustable rate mortgage applications remained high last week at just under 12% of total volume. The ARM share of applications was around 3% at the start of this year and had been for several years because rates were so low. Borrowers didn't need to take on the added risk. Not so much now. The rate on a 5-year ARM now around 5.5%. ARMs, though, can be fixed for up to 10 years. David?
Actually, Diana, I'm going to pick it up, and that's exactly where I was going to go with you, is whether this was pushing more people towards riskier options, and if so, whether this sets off warning bells for you, given the current macro environment and the rate environment, as someone who did cover the housing situation back in '07, '08, '09 so closely.
Yeah, Morgan, I was definitely there and I saw it all. But I will say it's a very different mortgage market. While these loans can adjust higher or lower to the market rate at the time, they are underwritten very strictly right now. Nothing like the loans that we saw back in 2004, 2005, the liar loans, the negative amortization mortgages. They are nothing like that. So I do feel better about those. I mean, there's nothing wrong with a 5-year ARM.
Shepard Smith here. Thanks for watching CNBC on YouTube.